And I'm recording out.
Okay, guys. So today we have a guest speaker, Alicia. She's a 1031 specialist, and I've done many deals with her. This is actually the first time I met her. Well, second time actually now, and so it's great. And then this is one of the things where if you ever get into the real estate industry, it's a strategy that you should know. So she'll kind of give you a brief talk about 1031 and what it is and so forth. And then Dr. Kerr will be hosting it because he was born to do this, actually. So why don't you take it over, Greg?
Well, we'll give it to Alicia. Just if anyone has any questions, send them to me in a private chat, and I'm going to ask her at the end instead of everybody talking over each other.
Cool.
So we'll give it to Alicia.
All right, I'll just jump in. My name's Alicia. I'm in Orange County, California. I'm from Midway City, California, which is just a small little pocket, population like 7,000. I'm 36. My birthday is tomorrow, actually, so I'll be turning 36 tomorrow. I'm first generation on my mom's side, third or fourth on my dad's. What else? I went to private school from like first to 12th grade. I did some college, but admittedly, I did not finish. I'm part of the LGBT community. That's kind of like a little bit about me. I started exchanges when I think I was about 18 or 19. I didn't know a thing about what an exchange was. I had no clue other than it had something to do with real estate. But beyond that, I had no idea when I started, and just learned kind of on the job going in, had, sat next to somebody and just did that for 4 years. And by the end of, by the end of 4 years, I was confident more or less in exchanges, still some little bit of learning. And right at that time, it was when the Great Recession hit and I got laid off. So I still continued in real estate, just doing kind of whatever I could find in the business. So I was a receptionist for a time. I was a junior escrow assistant for a time. I did title assistant work for a minute. And then when things kind of picked back up, the company that I was doing exchanges with initially called me back and asked if I would return to do exchanges again, and I agreed. And so now I've been back doing exchanges. I think this June will be the start of my 8th year, not including the first 4. So exchanges have kind of been a big part of my life, which has been cool. And so kind of getting into that now, the purpose of the 1031 exchange is to defer payment of your capital gains taxes on that investment real estate that you have. So for the IRS to give you that benefit, they expect 3 things from the exchangers that are selling investment property. They are having to do with the value of the property, of what you're selling and what you're buying, your vesting, so how you hold title to that property, and then some timeframes that they give you. So to kind of expand on those 3 bits a little bit more. On the value, the IRS wants to see that your investment, if you sell that, for example, at $500,000, that when you buy your investment property to replace it, that value is the same or more, so that it's, in this example, $500,000 or more, so that you're kind of taking at least a side step in the value if you're not, going up ideally. The second thing is your vesting. Again, that's how you hold title, so how you legally own the property. They want to see that, again, kind of matchy-matchy, how you came off the sale, that you match that on the purchase. So if you're an individual person and you own that as a single person, that you sort of mirror that on the purchase in your individual status. If maybe I was a member of a general partnership or LLC with Jason, for example, then the IRS would expect that we sold that jointly in that LLC, that we mirror that on the back end and we buy that jointly in the LLC. So they just want that kind of linear movement there. And the last thing being the timelines for the exchange. The IRS gives you from the close of your sale transaction a maximum of 180 days specifically. So it's roughly 6 months, but it is technically 180 days, calendar days, including holidays and my birthday and everything else, to complete the exchange in full. And of the 180 days, they require that within or by the end of the first 45 days, so that 45th day, that you identify the property. So this is your identification period. And they expect at a minimum that you state what is the property or properties that you intend to purchase to replace that initial one that you sold. And then if you do that, you're allowed to take the balance of the time. So that additional 135 days, taking you to day 180 to complete escrow. So obtain, legally take possession of that property. So if you hit all three of those points, you have your value. You don't mess with your vesting too much. There's a little gray area there, but you don't mess with your vesting too much and you hit the timelines, then they allow you to defer paying those capital gains taxes until a future point. So basically when you dispose of that property. So if you acquire something through an exchange and then ultimately you end up selling that property without exchanging it again, then you would realize the taxes at that point and your tax bill would be due then. So for the most part, that's kind of in broad strokes what the exchange is. There are some areas with regard to the replacement property value and how you hold title to the property. So you're vesting where there's a little bit of kind of case by case or wiggle room in a little bit of that. But if you hit all three of those, then you have a solid exchange, you get that tax deferment, and you just keep plugging away.
I got a quick question. So is it possible to never pay taxes then, to just keep kicking the can down the road, even after death? Can you pass this on and never pay taxes?
Yes. Yeah. So if you get something through the exchange and you pass away still with that asset, obviously you haven't paid the taxes on it. Depending on how kind of where that property goes next and how that happens, will kind of potentially change some things. So maybe that goes to your kids and they inherit it, then what they do at the time of inheritance shortly thereafter, or how ultimately they dispose of the property would kind of impact that. But they could certainly exchange as well if that's an investment property to them. So there is a potential that, you just keep stretching that thing out, or you buy a property through an exchange and then exchange that property and then exchange that property. So you might have different properties, more properties, less properties, but you're always just deferring.
Jason, is this what you do? Do you never pay taxes this way?
I have not. So I started off in 2011. Actually, Alicia has done all my exchanges. I think I've done up to maybe 12 properties so far, and I've not paid a single dime of capital gains taxes.
Wow.
And I don't intend on paying them. And here's the thing too. So right now I'm currently doing an exchange with Alicia. I'm selling a property that I purchased. It's 5518 Compton Avenue, which I purchased for $665,000 in 2016. And I'm selling it now for $950,000. So on paper, I made around $300K. But obviously, I'm selling it, and then I'm going to go buy other properties with it without paying taxes. So I was actually asking Alicia if it's possible to buy like land, and supposedly it's possible. And also, you don't need to just exchange one property, right? Correct me if I'm wrong. You could do multiple properties as long as the value is equal or greater, right?
Correct. Yes. So as an example, if you're selling $1 million property as your sale, your downlay, then on the purchase side, your uplay, you could buy 2 properties at 500,000. They actually don't even need to be even amounts. It could be one that's 250,000 and the other is 750, or buy 10 properties at 100,000. I mean, you do have flexibility in that sense. It's just making sure that you name those properties in time and that you close on them, within the allowed time frame.
So we keep saying properties, but I'm not too familiar with the 1031 because I don't have investment properties yet. But yet, I want to after having a conversation with Jason. Of course, everybody does. But I looked into it last night a little bit, and it seemed to say it's a method to transfer wealth between assets. It didn't say property. So is this just for real estate, or did I read that wrong?
For the most part, it's just real estate at this point. Previously, you could exchange personal property. So as I would typically see that maybe in conjunction with a deal I would be doing, I think kind of our classic go-to example is a gas station. So you have the real estate of where the gas station is and the personal property that is the gas pumps, the vending machines, the cash register, those sorts of things, maybe even the business domain or things like that. I don't recall exactly when, but I would venture to guess probably in the past 5 years, I want to say, that IRS chipped away at that, and exchanging personal property is no longer allowed. So I think now we're just down to real estate for exchanges. Admittedly, that's kind of my area of focus because that's what we're doing all day. But I don't think there are any other types off the top of my head that you're allowed to exchange any longer.
That's unfortunate. I was hoping we could talk about how to do this with cryptocurrencies because those are treated as assets by the IRS. So I thought, no, so that was my first thought. It's like, hey, if I swap, which I'm not doing, if anyone in the IRS is watching, I did not do this. I've never done this and I'm not doing it now. But if I ever swap, say, Bitcoin for Ethereum or Dogecoin, that's a taxable event, but they're treated as assets. So I thought if it's a like for like, right, it's a crypto for crypto, could we use this 1031? But you're saying no.
Not through what we do. I'm not 1,000% on that, so I won't go so far as to say absolutely not, but not through the specific types of exchanges that are what I do every day.
Okay, and now we can't even do the personal property, which when you brought that up, I had all kinds of creative ideas on what we could do. Like if we had a gas station, I could say, well, you know what? Part of my decoration of this gas station are these pile of gold bars that I let everyone look at. And, I'm going to transfer those into something else. So
the gas station's called the Gold Nugget.
Yeah, right. Have you ever seen something crazy like that?
I haven't. The business where I work, we do like a very specific type of exchange. We don't even, of the real estate varieties of exchanges, we don't even do all of those. So my personal experiences and knowledge is really honed in on this kind of standard forward real estate exchange. But even within that, there's reverse exchanges. There's, the build to suit exchanges I talked about before. There's a reverse build to suit exchange. So there's other things kind of out there in the same sort of umbrella, I guess we'll call it, but they operate a little bit differently.
What's a reverse exchange?
Yeah, like what is reverse exchange? I heard of it before. I've never done it.
Yeah, so the reverse exchange, the end game is the same. You're still just trying to achieve that tax deferment. It boils down to the closing order. So the forward exchanges that I process, you have your sale transaction close first. Your cash proceeds go through your QI, which like your qualified intermediary, which is what I do. And then they go towards the purchase, which will close then after the sale. So that's your forward way. The reverse is literally just the opposite. So if you found the property that you wanted to buy before you were quite ready to sell the investment property that you're holding, you get an escrow for the property you're buying. You link in a qualified intermediary that can handle that reverse exchange. They put that in place on the purchase and then set you up that way. And then you have 180 days from the close of that purchase to go and resolve the property that you need to sell. So it's just kind of going in the opposite closing order.
So you buy it first and then you sell.
Yes.
Oh. Is that a lot more difficult?
It is more involved as I understand it. It's definitely more expensive and they take a little bit longer to set up, and just kind of in a broad sense, the reason for that is there's more kind of responsibility, I guess is a way to put it, on part of the qualified intermediary, because the IRS does not allow the exchanger to have possession of both properties at the same time. So because of that, I believe what the QIs do in the reverse exchange is create kind of an LLC for you, and I admittedly don't know the particulars, but set that up for you so that there's this other entity that's sort of holding that newly purchased property until that sale is resolved. So doing it that way, all the requirements are met. But because they have to do that, it is, the cost, as I understand it, probably starts in the probably $2,000 these days. I'm kind of taking a guess. I think I've heard maybe 15 to 17 on the low end, whereas like my company, for example, only charges $700 currently to do just your standard forward exchange. So it's easily twice as much of a cost.
It used to be $500. What happened?
Yeah. Get it while you can. We're tired. Between you and me and everyone on the Zoom, it might be going up again. So yeah.
Can you also expand on one thing? So I want the students to know there's a difference between investment property and primary home.
Okay. Yes. So the investment property needs to be something that you hold as an investment. So in the case of, residential real estate, that's something that you're holding and you're renting that property out. You're not using it as your primary residence, so your personal home where you go home every day. You're not using it as a vacation home or a second home for yourself or something like that. So you're not, as the owner, using it personally. It's held as an investment that you're renting that out and you're generating that rental income. As far as I am aware, the big reason for that is that there's already tax code that gives you, exemptions on your primary residence. So those primaries just kind of fall under that category. So they do not let you exchange, your principal residence.
Yeah, I think for students, just so you guys know, if you live somewhere, you declare as your primary home, you're allowed. I think it's a Tax Act of 1997. If there are two owners on it, you're allowed basically no capital gains tax on up to $500,000 of profits on the sale of your primary home. So I think that's what it is. And then so you can't exchange your primary home, but there's a loophole around there, right?
To an extent, yes. Yeah. So kind of the loophole, if you will, is that if you have your investment property and you do your exchange there, so you buy that replacement property as an investment, and then you hold that and have it function as a true investment. So you're renting it out for, I would say most CPAs recommend a minimum of 2 years as an investment. And then you could theoretically boot your tenants, move in there, live there at least 3, I guess you need 3 years at that point to total 5. And then if you sold it as your primary residence at that time, you would get that primary exemption. So you kind of game the system a little bit that way.
And you can also reverse it, right?
Yes. Yeah. If you're coming into it, yeah, you could do a similar thing on the front end. Yeah. Where you buy something as your primary, get that good loan rate. If you're getting a mortgage, get it as your primary, kind of satisfy that, then convert it to a rental. So you move out and start renting it, have your rental, and then go forward through the exchange that way. You could do that as well.
And you're saying buying it as your primary home because you get a lower interest rate when you do that.
That's mostly what I see. Yes. The lenders, when they're loaning you that money, if it's as your principal residence where you're going to live, they tend to offer a lower rate for that money that they're loaning you versus those investment properties. Those rates are going to be
well, also lower down payment, right? You use FHA loan to buy a primary loan for 3.5% down. Yeah. And then you don't ever live there and rent it out. I know people who's done that. I thought about doing that.
I was going to say, are those people named Jason Chang?
Yeah, and then you get really good interest rates. So that's usually like a loophole. So a lot of students ask me, I was like, if I think the median house is around $700,000 right now in LA. So it's about right, $700K. So you want to be a normal buyer, you have to save $140K down, which is roughly about 20%. But if you're able to save like 3.5, let's just say 5% for the sake of it, that's only $35,000. Using FHA, buy yourself an income property up to like 4 units, declare it as a primary home, and then that's one way you could get into that type of like properties, I guess.
Get your foot in the door. Yeah, definitely.
And then you can exchange it afterwards.
Yep.
And it'll be tax free.
So you just got to move around a lot though, because you have to claim it as your primary home. So, I mean, do you have to change your official address, or how does that work?
I don't know that there's any real official answer to that. I would personally, just because I would want everything, my tax filing, I wouldn't want my lender to call the loan or anything like that, which is kind of a stretch, but the potential is out there, just so that all my records on paper, if nothing more, show that for all intents and purposes, this is either my primary or my investment, whichever way you're trying to kind of pitch it.
Or maybe you just move a lot. Maybe you'd like to move every month. Who knows? There's nothing illegal about that, right?
There is a thing when you do primary home loans, there is a clause in there on the loan that says you're not allowed to finance another primary home for 12 months.
Oh, okay.
I was able to get into a Hollywood property, a 4-unit. My intention at that time was to move in there. But when the time when the loan closed, my intention has changed.
It happens, right?
It happens.
But you still wanted the property. I don't know why.
Yes,
but
yes. And then I think I was able to get a very low interest rate due to it. So it's your intention. It's like murder. Same thing, right? The intention, that's the one that counts.
It'll be difficult to disprove an intention. That is correct. Oh, hey, here's a good question for Alicia. What if somebody lives in their investment property? So say, like I rent a guest house that I have.
Yeah.
How do we treat that?
I get that question maybe once a month. Or kind of a case where that's the situation, maybe once a month. And it's kind of a split. You're doing a little bit of both. So you can't exchange 100% of that property. You can only exchange the percentage of that total contract price that represents, whether it's here we have little casitas, so it'll be like the main house and the little house in the back. So if you're only renting out that smaller portion, you have to factor out, what is the percentage that this reflects, and then you can exchange that portion, but you can't just cover the whole thing under that because part of it is investment.
Is that a percentage of value or percentage of square footage, or how do we do that?
It's kind of tied in to both. It's the value. So to assess the value of, whatever that house is on the grand scheme of things, and you're getting kind of into square footage and that type of thing, just to calculate what that value is, because you will need to know it so that you can match it on the back end of your exchange. So if you have $1 million property and determine that 10% of this is income producing property, so your rental part is this 10% represented in the back, then your value is 100,000 for that overall contract price. So going forward for your exchange, you don't need to buy $1 million property. You only need to buy that 100,000 to match the rental portion.
Right. So just out of curiosity, I mean, this sounds like something I would just file on my taxes if I did this, maybe after the fact or something. So what exactly does your company do as an intermediary?
Oh, that is a fabulous question, because you are kind of right on that. There is filing that happens. Ultimately, your exchange, whether it's successful or failed, would be reported through your next tax filing, where you're reporting everything that you did for the year. So that portion is handled hopefully by your CPA or tax advisor, especially if you're getting into investment stuff. I always cringe a little bit when people are like, I'm my own CPA. It's like, okay, I hope if you do that as your living, that's one thing. But if you're just kind of doing your TurboTax, now might be the time where you need to invest in, having a CPA or tax advisor.
I should stop doing it myself.
At some point, yes.
I kind of enjoy it. It does take a long time, but it's fun.
Yeah. But as far as, what I do every day, or any qualified intermediary, the real reason we exist, to put it plainly, is to sit on your money in between the point that your sale closes and the point that it's needed for your purchase. Because again, the IRS, they do not want you to have a constructive receipt of those proceeds. So as soon as you were to touch the money, it's game over on the exchange. The exchange would be void. If you had one, or if you got it and then thought, oh, I just learned about exchanges today, let me do that. But you already received that money. IRS is like, oh, you touched it last, so you're paying taxes on that.
That's the part I was missing. Okay, so that's really good for you. That means your job security is pretty high, because they need you. They need somebody to hold that.
Yes. Yeah. So that's our big, that's, like I said, at the end of the day, that's more or less why we exist, obviously, as a company, and working to kind of advance this level, but just really to be there to support clients and answer questions like this, and kind of walk you through it and let you know you're going down the right path, or if you're kind of veering out of the lines, some sort of correction, or who you need to consult to figure out if that's going to work for you, or if that might be, a problem that could void or nullify your exchange. So, just kind of keeping everything on track, making sure the addendums, amendments that you need are there, making sure that what your timelines are. So 45 days, when is that? To calculate for you and let you know, okay, this is X date. And that sort of thing.
Yeah, because that would be a very expensive mistake if you accidentally touch that money, I guess, right?
Yes, and it has happened. And it stinks when it happens. And I don't like getting those calls that are, because the other thing too is the exchange technically does not begin until the calendar day following the close of the sale for the property, your sale property. So when you're selling. But you have to set up your exchange during that escrow course, so leading up to that. So once in a while, I'll get a call that's like, we closed escrow yesterday, but we want to do this exchange. And I can't do it. It's too late. So sorry, like, you're just going to have to pay the taxes. And then they may or may not say, well, and we already received the funds, and it's a definite no at that point, because now you're in receipt of the funds, and you're after the point of closing when you needed to establish this. Sometimes people will say, well, the money's still sitting at escrow. In that case, no, you didn't touch it, but you also didn't have that exchange set up, when you were supposed to. So in those instances, the company I work for doesn't allow us to sort of retroactively, tinker with stuff and try to add it on after the fact. So those are kind of tough calls, because people are realizing, oh shoot, I'm going to have, maybe up to 30-ish% that I owe in taxes now. I didn't realize that, and what can I do to fix it? And it's too late at that point, and it stinks. Those are not fun calls.
Yeah, no, those tax percentages are likely going up in the future, maybe even this
Yes.
year. So
Yes.
we got a good clarification question here. Actually, that's a good question. So when you're doing a 1031 exchange, are you not allowed to keep any of the money? Can you keep some of it and be taxed on a partial amount, or do you have to invest all of it?
Yeah, so you can affect what is then essentially a partial exchange. So instead of the total exchange where you're getting full tax deferment by doing, kind of hitting those 3 points, you would, if maybe your value is not as high as it needed to be, or maybe, by choice or by force, you did pull a little cash out, then that's a partial exchange. So you can do that. You're paying taxes on either the difference between your higher sales price and your lower purchase price, or the amount of cash boot, or just cash that's left over that's not being applied towards the purchase. So whichever of those two figures are larger, then that's where the IRS is going to look to tax. So you can do it. You're just opening the window for taxes to be owed. And kind of like I touched on earlier, ideally when you're doing a tax deferred exchange, you're looping in your CPA as part of your team to help you. And you should do that always when you're exchanging, but especially if you're going for partial exchange, you want to keep an eye on what is your actual gain, and doing this exchange, what would my tax exposure be, and just making sure that it's not becoming unbalanced and your tax exposure reporting an exchange that is done incorrectly would actually cause you to owe more taxes if you reported it, which a good CPA would not, but more taxes than your true amount of gain, which is kind of most people that I try to explain that to are like, wait, what? So it's kind of a tricky one, but I guess I'm trying to think of like a really simple example of that. I guess if you had a property you're selling at $1 million, let's say you bought it for 500,000. So in broad strokes, your gain now is 500,000. So you're starting the exchange to hopefully defer $500,000 worth of taxes. And so you get your 500,000 of proceeds in the exchange. You're looking for that target $1 million plus purchase price to, apply that. And I can't really think of a good reason why this would happen in a practical sense, but let's just say you only end up buying for 400,000. You could only get a property that was a total purchase price of $400,000. So,
well, you might want the cash, right? That might be a reason.
So yeah, you could pull it out as cash, which is, again, just plan for that. But in this kind of thing is like, okay, so maybe you tried to hit $1 million, you only got in at 4. So if your CPA reported this exchange in your next tax filing, they would look at that and say, you're $600,000 short, so you owe us on $600,000, which makes no sense because your true amount of gain is only 500,000. So a smart CPA would be like, we're not even saying you did that exchange because it's causing you to owe more taxes than are actually due. So those don't happen too often, but sometimes I think where the potential for that is having to do more with misinformation. And people often think, it's one of the things that I get questioned on most is, oh, I thought I only had to spend the amount of cash that I received from the sale and that would be enough to satisfy the exchange. And it is not. So that's where people can run into trouble. They might have that $1 million property, paid off a $750,000 loan. They got 250 of cash in the exchange and thought, oh, I just need to spend 250 and I'm good. They buy at 250 and lo and behold, it's a bad exchange and they owe all the taxes that they were going to owe anyways. Did them absolutely no good.
I'll be honest, that's exactly how I thought it worked until this meeting.
Yeah.
I'm glad we had this conversation.
The number one thing that I get, and the number 2 spot that people kind of confuse, or I don't know if it's misinformation or just for whatever reason, the 45-day identification period. I almost always get, oh, and I have 90 days to identify. No, you do not. You have 45 days, and one segment of 45 days only. You don't get another 45 days after that and another 45 days after that. You get one identification period of 45 calendar days. So those, I think, are the two places that most people always hit me back with oh, I thought, or my agent told me, or, my neighbor told me. And it's like, no, that's inaccurate information. Please don't use.
You can't just include a note on your taxes saying, hey, misunderstanding. Jason, I thought Jason said I had 45 days.
Mm-hmm. Yeah.
Here's a good one. Okay. So I didn't even know about this one. Questions about Biden's proposal to cap tax deferments above 500K capital gains for the 1031. Do you know about this? And what effect do you think that would have for your firm and investors?
Admittedly, I don't know too much about it or totally what the impact would be. Right before election, it was a question I got a lot, and it's always kind of a sensitive-ish subject on the phone with a client because it's touching on politics and a lot of other things that it's just like, ooh, I don't really want to get into that. Because it can get a little touchy, especially around election season. People feel very strongly about however they're feeling. And having done this for 10 plus years, every time a new president is in office, there's always rumor and speculation that this will be the president that pulls the plug on exchanges or does something else in the tax code that would effectively, get rid of it in some way. And I guess plainly, after hearing the rumors so many times, I'm just not fazed by it anymore. So I don't really invest any energy into really getting into the particulars. I used to when I was younger, because I was like, oh shoot, I could lose my job at any moment. And this far into it, I'm like, I guess. I mean, I could, but it hasn't happened yet, which might be a little cavalier as they are chipping away at different parts of our particular Section 1031. And there's certainly the potential. I mean, he could do it or change it in a way where maybe it's now only beneficial to, kind of a certain demographic, for lack of a better word. But I try not to stress about it too much.
Yeah, they are chipping away. I can't do my gold bar scheme anymore in my gas station.
Yeah.
But well, I mean, what would happen if it was capped at 500K? If you could only defer 500K of value on the taxable value. I'm thinking about this, especially after you just said it's not the profit that I have to spend, it's the whole value of the asset that I might not have ever paid for, right? It was a loan. Well, then that really decreases the tax savings from this, especially in a place like California, right?
Yeah. I guess it's
Now, obviously, people would still want to do it if you're switching properties, selling one, buying another one. You would still want to do it, but would you see this greatly decreasing the amount you would have to file for your customers?
It could, but I mean, that's dealing with people that are, capped out. So if that's at that point of 500,000, I don't know. Well, I guess now is kind of a weird time where properties are just.
Actually, I think it might help your firm, because most exchanges I've done, I have less than $500,000 in capital gains.
Mm-hmm.
So let's say if Biden said, okay, I want to cap the capital gains at 500, right? So let's say I bought a property for 650. I usually didn't have time limit to wait. And I say, oh, maybe I'll sell one's worth $1 or $2 million. Yeah. But if there's that 500K, once it's close to it, I might just initiate the sell earlier.
Yeah, get out of it.
Go buy something else, right?
Yeah. That's a very good point.
So because nothing I've done so far has hit it. I think Pomona, when I bought those condo, Craig saw it. I think I bought them for 100. I sold them for 240. So I made 140. Then I bought this property for 665, and now I'm selling for 950. I made 300. So nothing has hit that cap yet. But I think if they do put a cap there, then for sure I would be more aggressively selling them before they hit that. So I feel like I would do more exchanges actually, to be honest with you.
Yeah, there's strategy to that. Maybe in more like commercial deals where you're looking at just larger figures in general, might kind of curb some of those to an extent. I hadn't really thought about how it might impact sort of sometimes people will sell out of or buy into what's called DSTs. So those are Delaware statutory trusts. And those are kind of projects, for lack of a better word, where it's, maybe a $3 million Target shopping complex, and there's a Target and, a Whole Foods and whatever else is in the strip mall. And so that huge transaction has hundreds of investors that are all taking, 0.00267% of the pie. So they're all getting their little slices. I would be curious to know on a big deal like that, how does that all kind of work? Because those are a little more set in stone for you, and you're just buying into that offering. You have less control, kind of like you were saying, Jason. Well, I might be more aggressive in sales and selling sooner as I'm going to approach that, threshold, whatever that might be. With a DST, you don't have as much control over something like that. So I would be curious to see how.
I did get into a deal. I think Craig came with me once. Remember, I went to look at Crown Plaza in Costa Mesa, and then we purchased shares of that hotels. And some of the investors basically bought it with 1031 money, and they bought shares of it.
Yeah.
And then it wasn't as big as like, 950. They only put in like, 500. I only put in like 25K, and I think I own like 1% or something like that, like less than 1%. So, I mean, for those deals, I think 500K is plenty.
Yeah.
So it sounds like, let me think about this. So if you have a large property with a lot of shareholders, you can spread out the tax deferment, but there will be large investors who might want to do less 1031 exchanges. Like Jason, you're saying you don't reach 500K, but if you did, you would just sell early. Well, there's large investors making millions and millions a year who are now saying, "Oh, maybe I'm going to hold on to these longer." So I guess it depends on how many large guys we have and how many smaller fish we have in the market.
Yeah, I agree. I think obviously it used to be a 20-80 rule, right? Like same thing with real estate. Like I think the top 10% owns 90% of the large buildings now, or something like that. Like me, obviously much smaller, so I don't ever hit that threshold. But yeah, I could definitely see there's going to be less exchanges on the larger side, but probably more exchanges on the smaller side.
Yeah.
So actually, but they charge by per exchange, not per value of exchange, right?
Correct. Yeah.
So you might gain out of that.
It could. We never know. Never know.
So I think actually might be a good thing for them, to be honest with you. It might not be good for me, I'm saying. But
it might not be good for my health. There was a time right at the start of COVID that I was working like 15 to 18 hours a day, like 6 days a week. And I was just like, I can't do this anymore.
You get commission?
I don't. Where I work, they treat me really well, so I have no complaints about that. But I know some intermediaries do work on a commission structure, so I could see where maybe you're more motivated in that sense. But there's only so much. Even if I wanted to, quite frankly, I realized, we were doing kind of what we had to do just with the tools that we were given. But in the grand scheme of things, I don't feel I was doing my best work on being in an office, 15 to 18 hours a day. By hour 10 and beyond, just my brain starts to go. So I don't really like to operate that way. I don't think it's beneficial to me on a personal level, whether the money's there or not, and certainly not to any clients. Like I'm not giving 100% at that point. I'm kind of burned out. So I don't really like to do that.
You seem to like your job. I
enjoy it. It has its moments, like right now. So for whatever reason, I don't know really now in 2021 why this is, but the end of the month is just everybody's trying to close. I assume it's participants in the transactions that do receive commission probably want to close by the end of the month to get their paycheck, but everyone's just pedal to the metal, right now to close this Friday, the 30th. That's the last day of the month. So it is just popping right now. I go in and it's money going out on one end, money coming in on the other, processing, a lot of questions, a lot of last minute things come up. This week, last week of the month, almost every month is when I get the calls of, I didn't know I had to set up my exchange before. We're closing in 2 hours, or we're closing tomorrow, or we're closing Friday. Can you help us? And like I started today, I just start telling people, unfortunately, not I only have so many hours in the day, and I would love to help you, but it's just too late at this point for us to get it done. So best wishes. Like, here's another company I know of. I hope that they can help you and get it done for you, but it's just wild. So it's very cyclical, and it slows down in the beginning of the month. So I enjoy it on the whole, but there are definitely times where it's a little stressful. There's a lot going on. There's a lot of moving parts. There's a lot of people involved on every transaction. So it's just can kind of add to the stress.
How did you even get started? How does one get started as an 18, 19-year-old in this business? That's the part you skipped.
Oh, man. By accident, by luck, by chance.
You just walking down the street, you slipped on a banana and fell into a job doing exchanges as a teenager.
I'm almost. So the only other job that I had before I started doing exchanges was my neighbor was a lender. And so at 16, 17, 18, I would go to her office and literally like get coffees or copy this file, or, back then, everything was like still a little bit typewriter for some things, wasn't fully computer yet. So just doing whatever she threw at me. That was kind of by chance. And then the switch to 1031s was my girlfriend at the time actually worked for the company that I worked for, and she was leaving to get into escrow. So on her way out to do escrow, she's like, they're gonna need somebody in here. Like, do you want to do this? So I thought, well, I don't know what it is. I don't know if I can, but I'll try it. Let's see what happens. I'm 18. Really, what do I care? They offered me, good money for back in whatever year that was, 2003 or 4, somewhere in there. So I took it, and I remember it being stressful when I started because, I was just green as an 18-year-old person could be. I didn't really know much about real estate. I definitely did not know what an exchange was, how it worked, why we were even doing it. I had never bought property or sold property at that point, so I had never even participated just in a escrow transaction to know anything about anything. And so I just signed up. They did a kind of not too formal interview with me. They seemed to like me. They asked me to come on, and I just started learning kind of from the person I was sitting next to. It's like, what is this? I got this request, and what does this mean? What is an earnest money deposit? Oh, that's, this particular thing. Here's how we do that. What are escrow instructions? I didn't know what any of that was. So I just kind of learned, little pockets of information and here and there in no particular order. And then, over time I was like, oh, okay, I kind of get this now. I'm feeling a little more confident in what I'm doing. Oh, okay, now I can kind of explain this to someone that calls us, and I can kind of give them some of the particulars. I might still need to ask a question or two to somebody that's been here longer when they're more complex, but it was just learn as I go, in the gauntlet at the end of the month, just like all hands on deck, do whatever you know how to do and ask questions. And just, there was no Google, so I couldn't Google. There were no YouTube. YouTube didn't exist, so I couldn't YouTube it. I remember actually, I think it was probably in my second or third year. It was hard to even find a book specifically about exchanges, and it was, I think, around the time Amazon was new, and I think I ordered one of my first 1031 exchange books from Amazon when that was a bookstore, to try and learn, like, what am I doing? Like, what is this? But most of it was just learn as you go. But I still, to some degree, there are things that pop up where I'm like, oh, I've never had that before. What do we do with that? I don't know. And then I have to figure it out. I'll call a tax person I kind of lean on, see if they can give me any advice. I Google things. I try to read the tax code and see if I can figure out what they're telling me, or tech memos from the IRS to try to understand from other people's sometimes misfortune with the IRS, how they approach something and how they view it, to just figure it out as we go, if there's no previous kind of example or experience to work off of. So it's been totally just on the job. I can't even imagine what a course for learning exchanges would look like.
Jason teaches one if you want to take it.
Okay.
It's part of it.
I would love to.
Yeah, it's part of it. But so is your firm hiring right now?
Yeah, there's always a potential for it. I can use the help. I'm training someone right now. So it's that same kind of thing where I'm like, okay, you're fresh out of college. Just graduated college. She's 20, just turned 23. Same as me, no real estate background, has never participated in anything. So we're just starting from the ground up of like, okay, this is what this means. This is what that word means. This is kind of what we're trying to do here. Just learn as we go. So starting the next generation, I guess.
Hey, Craig, there's a question here. I was wondering, did you ask that yet about a double counting issue?
Well, I didn't catch that. If that was to me, a double count.
Oh no, Craig. Did you see
So
that?
I think I answered in privately, but there's one more remaining question, and that's a particular in terms of how do we determine the profits of these sales when you get a loan to buy the original property that was your investment.
Mm-hmm.
Do you just look at the sales price minus the price you paid, or do you also factor in there the loan payments, the mortgage, and the interest that you had to pay, or the interest specifically, I guess I should say?
That is an excellent question for your CPA or tax advisor. What I would say to a client on the phone. Maybe that interest plays in part somewhere, but as far as the kind of practical execution of an exchange, the loan is sort of a side factor. I mean, it's a useful piece of information, but as you're trying to figure out, okay, what do I need to do for this exchange? The loan should just sort of, I don't want to say be an afterthought, but
What the way I did it was, so for example, right now the property I bought for $665, now I'm selling for $950. I have a $570,000 loan on it. So once everything's said and done, when I pay the commission, the escrow, the 1031, what's left of it is about $320,000.
that was like your closing costs. Yeah.
Yeah. So that's not enough to buy more than $950, except that you have to get a new loan, right?
Well, with the loan, you do have to get a new loan if you need it
to be able to exceed that value, basically.
Yeah, but if you had the cash, you could replace the loan with cash. So then that's
so if I have another amount, let's say I sell for $950, I want to buy $1 million, and if I don't get a loan, unless I have the extra money sitting in my bank to come in and buy the $1 million property, then I have to get a loan. That's the way it is.
But I guess the question is, are we treating that interest as a cost against the profits, right? So like if in total you paid 20 grand of interest payments, do we take that out of the profit from selling the asset, the property?
I don't know the interest.
The interest would go off. You would be writing that off from last year's income of that property. Because remember, it has to be an investment property. So it would be treated separately as the income of the property from last year. When you sell it, there's no consideration of that because that amount's already taken out.
Yeah. What
And
you
whatever the debt is that day, that's it. You know.
is closing costs. So maybe
Yeah.
it's not really an answer to this question, but as an aside and kind of in a similar thing, your closing costs. So if you're selling at $1 million and your commission is 30,000 and your escrow and title fees are another 10 and that's 40, you could chip that off the million as allowable expenses, and now you only have to buy at 960 and you're still satisfying the exchange fully and getting that full tax refund.
Oh.
Okay, so that I guess that makes sense because those fees are associated with the exchange itself. Like you have to pay them to do the exchange.
Right. And to
I'm
get
just
out
trying to understand the logic. And then the interest payments are not necessary. You could have bought the thing with cash. So that's like a financing charge that's separate from this asset. That's like a separate decision, I guess.
I would think so. And even on the buying side, IRS does not consider loan costs to be an allowable expense. So if you wanted to buy down points or, there was some sort of loan fees due, those aren't even considered allowable expenses for an exchange, like for your exchange fund. So yeah, I would venture to guess kind of that interest would be an aside kind of from what's happening in the exchange.
All right. Well, that's all the questions we had, Jason.
All right, perfect. I want to thank Alicia for coming here, spending her time, giving us a talk. Yep. Hopefully some of you guys learned this. And if you guys are interested in this career, maybe, I could send them to your way, Alicia.
Make a connection, definitely. Yeah, I foresee that we'll probably be needing more people to help us as like the volume is seeming to just increase without end. Can always use help, so there's certainly the potential. Absolutely.
Okay, perfect. So yeah, it's about 1 hour, so that's about right. And yeah, I appreciate you coming to give us a talk today. Thank you very much.
Absolutely.
All right, thanks, Lisa.
All right, we'll call it a day for now. Have a good one, guys.